Hi, this is Efrem Hoffman broadcasting live from NakedSwanTrading.com on June the 4th, 2012 at 1:59 p.m. And this is a very special week. As we indicated a while back, and actually in the beginning we indicated back before many of the commentators around the world actually anticipated a strong downward movement, we were seeing signs of a major breakdown in the world economy and financial markets well back into the April period as the market tried to make a peek into that early May period in a lot of equities before rolling over sharply. One of our big calls in the big name was Apple Computer, and then just recently last week in our webinar and some commentary on Twitter, we indicated that the market was going to break down, as well as Google was going to be the next tech stock to crack the NASDAQ market and take it into new low territory. This week, the focus is going to be on a few responses that we got back from readers. There are some readers that follow Elliott wave theory and other technical analysis studies that indicated that some of those systems were saying that the market is going to be scaling and sustaining itself above the 1500 area as we progress forward, and that this is the best time in history to buy stocks. Now, what I have to say is that there's two sides to every trade. And at Naked Swan Trading, we see the exact opposite view. Yes, there's going to be bounces along the way. Yes, there could be very large rallies as the market descends towards its final objective on the downside. But the key thing to keep in mind is, as an investor, you want to make sure that when there is a rally, that it's a sustainable rally and a healthy rally that incorporates many of the tenets of financial theory. And a healthy rally would mean that the financials, technology, which is a big part of the economy, and the bond market, and industrial activity, along with discretionary and retail, is holding up very strongly. And this is exactly not what we see going forward. So I must take the view that people that follow Elliott wave theory that happen to be seeing something very different than a major bear market is in for a serious surprise. Now, I have to say that Elliott wave theory is a theory that if you lock 10 people in a room and they do the analysis at any given time, they'll usually come up with 11 different answers. So the point is that while it might be a theory, it's highly subjective, and there's a lot of other research that goes into it to make it a practical trading tool. And that is what separates the great traders or the great analyzers from the poor ones. Now, at Naked Swan Trading, our goal here is to turn black swan events into actionable trading events. And that means to strip the mask of invisibility of the black swan so that the events they portray become visible to the naked eye. And that is why we call our site NakedSwanTrading.com. And what I see right now on our trading screens is a very ominous signature for the world capital markets, both in the very short term as we progress through this week, as well as through this month and into next year. So let's now focus on the immediate week ahead of us. So it's currently Monday. What do I see on this map? Well, what I see on this map, as I indicated in the prior webinar, and actually in the prior webinar I indicated on May the 28th that there was an extreme resistance up around the 1333.75 area, which I believe that the market would have a very difficult time sustaining at that level before rolling over sharply into the 1st of June. And I said something like after 7:20 in the morning and beyond, risk becomes amplified. And that's exactly what happened. Risk became amplified dramatically. And I also indicated that there would be problems going into the first week of June. So we're now in that period of the first week of June. Markets sold off strongly overnight. And I indicated that we have a confluence of time frames that happen to be flatlining zero momentum into the future, which basically means that when price gets underneath that area, it's going to be extremely difficult to put together a rally that has any legs and any level of persistence before rolling over strongly. Now, I have to admit that this is a very sharp drop from that 1333.75 level all the way down to the 1262 area. So it was natural that there was some retracement, intraday, and now it's kind of pushing back, towards the lows. But what you should keep in mind here is the big picture. And the big picture is that just like 1333.75 was major selling area before new lows, this week you should be keeping an eye on this yellow boundary and this blue boundary as acting as formidable resistance as the market continues to make persistent new lows. And the first wave of this confluence of selling goes in, well, in some equities it goes into June 5th at 1:16, but on many into June 8th at 1:57 p.m. Okay? So basically, we've got some caps in at around the 1301 area, maybe 1307 if a cap intra-week, and at the low end, 1293.75. And you can see today, the market got as high as 1281.50. It couldn't even get that high. And the fact that these are caps doesn't mean that the market's rallying there. It just means that if there was positive news events or just general market trading activity that allowed the market to push up there, it would be met with extreme selling pressure in the very same way that it was met here, except this time the selling pressure is likely to escalate dramatically compared to this selling pressure as we progress through the June period. Okay? And what is scary about this, that if we do end up getting a rally up to this upper end of the resistance, the distance between the upper end here and the lowest level that the market came from, whatever that level happens to be before it rallies up there, that distance, you multiply that by about 1.5 and then subtract that distance from the low, and that'll give you an indication of the next critical area where the market wants to head. Okay? Now, once we pass the area where it's zonal, that mathematics does not apply for this region. Okay? So now, if we take a look at the bigger picture, okay, and which I'll show you in a second on the daily charts of the SPY, which is the ETF that is related to the S&P 500 market. The screen that you're seeing right now happens to be the S&P 500 June futures market, which happens to expire this month. And yes, there's usually a difference in values between what the futures indicate and what the cash market indicates, but as you get towards expiration, it converges to zero, and we're getting awfully close to expiration and also just a few days away from a rollover where the next contract month that's going to be trading on the S&P E-mini futures is going to be the September contract. Okay? Typically that happens around the 8th or 9th of the month. Now, and it's easy to actually tell because you could tell when the open interest levels and when the volume really starts to dry up and when volume starts picking up in the September contract. And the global support levels, for this summer, and this does not apply to the zone that we're talking about this week, but for the summer is 1342, 1356.50, 1365, and 1376.50 if a spike. So the idea that some Elliott wave watchers are seeing the potential of the best buying opportunity in history and rallies above 1500 that are sustained, it is not a reality at this point in time. It may become a reality well into the future, but from our point of view at Naked Swan Trading, that is a future so distant, it's not worth looking at right now. And we should be focusing on what is real and what is going to impact your pocketbook. And what is going to impact the pocketbook are people that are long the market that do not realize the level of downside risk that is about to hit this market. And I do understand that, a lot of market players will go back historically and try to see periods where we've had this kind of downside action and then think that, well, the last time it went down this much, or the last time the RSI readings got so low for such a long period, or the last time the MACD got overstretched or oversold to a certain degree, the market always had a major snapback that was sustainable. Well, let me tell you something. At Naked Swan Trading, we don't look at the past. We look at how the perceptions of traders on all time frames and how they got trapped into trades as the market moved into high territory, and how those trades will get unwound when those perceptions cause other traders in the future to make decisions that accelerate the trend. So we have come up basically at Naked Swan Trading with the mathematics that describes how information propagates across trader time horizons and creates information contagion in episodes of crisis. And we happen to be in one of the greatest episodes of crisis I have seen in my analysis, and I've looked back to the markets over hundreds of years, and this is unprecedented. So buckle up. Anyways, what I'm going to do now is I'm going to take you to a daily chart of the S&P. And the daily chart of the S&P, and actually this is the SPY market, okay? So it's the ETF. And this is showing you the big picture, okay? And basically what it's showing you is that, okay, this is where we originally indicated our sell, where we had a confluence of boundaries that were capping it at the top. You could see we're still capped here in the long term at 135.67 and 136.13. We just broke some critical areas, and that happened to be the same level that I just showed you on the short-term time frame on the S&P futures. Okay, so we took out the lows. We've got some zonal action, meaning a confluence of small time frames that are horizontal over here, which means that as prices go underneath it, people's perceptions in the future are going to become more bearish. Any lines that are sloped up mean that the perceptions of how traders on different time horizons, and each one of these colors represent a different time horizon. The further out it is into the future, it's a longer term time horizon. And you could see we've got consecutive series of these boundaries all sloping up into the future, and even the lower boundaries starting to slope up into the end of the year. So basically, between now and the end of the year, we've got tail risk down to these areas here. So 1169.50, 1150, 1106, and in the near term, 1235.50. Okay? And we just crossed underneath this purple boundary, so the next level is this boundary over here. We are capped at this teal boundary. Okay? So going all the way into August, we're capped at that 135.67. It starts out today at a level of 130.85. Okay? So basically, we don't really have to worry about that level of a retracement because, as we indicated, for this week, we're pretty much capped. Well, for this week, we're capped underneath this confluence level. So right around this area will be capped, like 129.97 to 130.71, and that's at best. That's if you. I just don't see that being a scenario. I see this market escalating on the downside dramatically. You could already see high frequency boundaries already projecting down to 125.86, okay, and substantially lower as you move forward. And there's a lot of stocks that I've identified from a diversified groups of industries that are likely to break down like I've never seen. We're talking $100 stocks falling to below $10. In some instances, $100 to $1. Okay? A 99% drop in the value of some securities as I see moving forward. This is probably the biggest shorting opportunity in the market. Okay? Now, the areas that I see getting impacted. And I would have to say not just impacted, but likely pulverized. And that will basically be industrial stocks, chemical stocks, insurers, and dividend equities. Okay? Google is also going to be a stock that is busting down and breaking down from a bubble. Oil trusts like MVO, as well as big name oil companies, as I indicated in the past number of webinars over the series of months, is APC and XOM. And the standout play right now, and I just put it on Twitter on Sunday evening, is CMI and NC. And I'm going to take you to that chart, and here's what it shows. I'm going to take you to the chart of NC. And I saw a very dangerous situation last night, and I've been watching this. I mean, we had sell signals in here, but now it's really at the critical point where this whole sell wave is going to escalate dramatically to the downside. You could see here, this is where the market closed. I put the warning out yesterday evening. So that was, it was at $100.26. We've already gone down as low as $97.54. So that's, $3 positive if somebody actually went short. Now, we've got a confluence of boundaries that happen to be zonal, horizontal, and then price got underneath it. So there's no level of support. Everything is sloped up until you get down here. So we're talking about, serious tail risk down to $60. Okay, very, very, very quickly. And longer term, I see actually an objective somewhere down at around $10.29 for NACO Industries. And if you scroll back to the crisis that we had in 2009, it also had a history of going from about $180 all the way down to around the 13 level. So we see that 13 level being breached in a big way, and once it gets down there, because all these boundaries are sloped up, likely much lower than that. So this is a dire situation, and this is really just one piece of the puzzle, okay? And this is not the only stock in the industrial sector that actually shows a massive breakdown. If I take you to Cummins Engine, it's another stock that looks like it's absolutely going to get decimated. And we're talking about down to the bottom of this red boundary, which is about $1.93 to $1.44, and it's still sloped up, so it could go lower. You go back to 2000 and, during the crisis, it was as high as, we're talking $80, and it went all the way down to near the level of around $17. So we're talking about blowing out those lows in a big way. This is a very volatile stock historically, but it's about to prove that it's even going to be more volatile. And we also put a tweet out last night indicating that this sell wave was going to escalate. I mean, originally we were aware that it was going to sell off from the peak above the 115 area, okay? But now it's really going to go into a crash territory. And on Friday evening, it was at 93.56. We warned about the crash being escalating this week and onward for the rest of the year and into next year. And right now, we got as low as already 89.44. So that's already, almost $4 lower, and the day's not up. And yes, we do have a boundary that's sloped down over here, so it's possible that there could be some short-term support in the $82 area to $74 area. Okay, but the key thing to keep in mind is that this teal boundary is long-term resistance. So 113.13. So for whatever reason, if the market ever rallies back into there, and but it's probably going to have a hell of a time getting back above 95.84. Okay, at least for the next week. And there's a lot of downside action that could happen considering all the industry groups that are breaking down right now. And as I indicated, there are a lot of industry groups breaking down. Even consumer discretionaries and retail are starting to actually show weakness. I mean, it's still true that the consumer goods area, such as the XLP and consumer staples, have held up the best. And even if they do come down because of this crisis, they will definitely come down less than the industrials and chemicals are getting beaten up. Those are the absolutely worst areas, and I'd have to say NC and CMI are among the most dangerous equities, along with GOOG moving forward. There's so many others. There's about 250 high-impact equities that have been identified. And what I'm really proud to announce is that this month in June, we're actually going to be launching a subscription service that will actually open up a considerable number of equities to subscribers that have these high-impact signatures before anyone else is aware of these situations. So it's really going to provide tremendous market intelligence and research and risk intelligence for day traders, investors, as well as fund managers that are seeking to identify where the hot zones are going to be in the market, and then eventually where the hot zones on the upside are going to be after the tragic sell-off takes place and decimates many equities. Okay? So what I'm going to do right now is now take you to the NASDAQ market. So I'm going to now take you to let me see over here, the 89-minute chart on the triple Qs. Okay? Because so far we talked about the S&P. Let's talk about the triple Qs. You can see here we've got a zonal flow, which basically means that we have a confluence of investor perceptions that are flatlining between now and the end of the week at around 157 on Friday, which basically means that there's going to be extreme resistance in the area of 61.18 to 60.59. Okay? And if there was an up spike, it would be contained by the upper end of this box at about 61.77. This is the immediate short-term analysis going into the end of the week for traders that want to take advantage of this, because now this is very key, because this doesn't just apply to day traders. We happen to be breaking down on an 89-minute chart, but this happens to be resting on a very important boundary that extends well into the daily, weekly, monthly, and yearly time frames of critical risk. And the next level that it's pointing down to and I wouldn't say it's necessarily support, it's just tail risk. And yes, you'd normally get bounces along the areas, but the point is lower levels even from there. 52.59 is the next major level. And the speed that it's going to go down from this current level, and we just got underneath this boundary in the past number of hours, is going to be a lot faster than any of these down waves that you've seen over here. It's going to be, I don't know if it's necessarily going to be like the May 6th flash crash, but it certainly has the potential to develop into that as we progress through June, and then there'll be some episodes in July that we're going to have to contend with, and we will be updating you on a weekly basis on that. And so right now I'm going to take you to the daily chart on the triple Qs, and you're going to see what kind of risk it's resting on. And you're going to see over here that we've got a number of boundaries that are in confluence. If I zoom in over here, you're going to see that boundary that I just showed you on the 89-minute chart. It was this boundary and this boundary that are in confluence. So basically, you're going to see a dramatic push. Once you actually see a daily bar, and you will see it, it's not a matter of when. You're going to see it very, very soon. You see a daily bar that has a high below $60.04, or just price trading underneath $60.04 for at least a day. You're going to be underneath this purple boundary, and the next gap level is this teal boundary, which happens to be exposing us to risk to the 59.59 area. That's in confluence with longer-term boundaries that are sloped down. So that's likely to be an area that is going to hold. The lower end, if there was some dire news, would be 49.37. But it's unlikely to hold after we pass through the end of November or somewhere in December. If we somewhere going in between there and February get a prices trading underneath $48.66 for a full day, you're talking about gapping down to the $31.79 level, and then all bets are off. Any retracements will get killed, and you're going to break through the 2009 lows. That's not a matter of when. That is going to happen. It's just that let's deal with one step at a time, and the next major step is the 52.59 area. And that is dramatic, because it took a whole lot of days for it to come down like this. When it starts getting underneath here, you're going to see panic selling. And panic selling is definitely not a good situation for this market. Now, what is fueling this sell-off? Now, well, number one, it was a bubble that, basically money that went into the stock market that never should have, because people were seeking risky assets because they couldn't get any kind of yield in treasuries. And then they started trying to seek dividend-paying equities. And dividend-paying equities themselves are also in major turmoil. And as I indicated in the prior webinars, and I'm going to take you to the chart, the S&P Dividend Index happens, here it happens to be, and I was warning over the past number of weeks that it was going to start accelerating on the downside, and you could see over the past number of days it is starting to accelerate on the downside, and we're expecting a move down that is not going to be pretty, all the way down here, which is $32.30. So I wouldn't look so much at the magnitude in terms of the absolute level. I would look at the relative impact of this relative to how prices have been confined to a very small level. So the expansion in volatility is going to be a tremendous surprise to many investors. And if I now take you to the, I'm going to take you to another chart over here, which we've been looking at for an extended period of time. And that chart is the US dollar. Now, because U.S. equities are priced in U.S. dollars, every time the U.S. dollar goes up, that's negative for the equity markets. And you could see here the U.S. dollar has been heading up recently. But even with the market, even with the U.S. dollar down today, the market is still having a hell of a time being in positive territory. So that's another sign how you know you're going into a panic episode, that the dollar isn't even helping you. But the key thing to keep in mind is that this, whatever retracement we get on the dollar on the downside, which happens to be a positive, which happens to have a positive effect on gold. Okay, now it's not the only thing that impacts gold, because gold could also be affected in a liquidity crisis. If there's a crisis, yes, a lot of times people will go to gold, but sometimes people have to sell assets off in order to cover debt. And if gold happens to be something that was rising in the short term, then they could actually sell it off. So you've got that factor impacting gold. You also have the fact that there's a long-term uptrend in the U.S. dollar, okay? And right now, if there is going to be some major upside movement in the dollar after any kind of retracement in here, okay, and there's a lot of support in the 80.75 area and long-term support in the 77.14 area to 75.91 area, we've got this zone here where this purple boundary is sloped down on top of this teal boundary. And that goes into the January, December area, okay? So January of next year. So given such a long period of time where there could be a rapid acceleration on the upside, how high could this accelerate? Well, you could get an acceleration into the 91 area, or even long-term into, I'm not saying it's going to 117, but that would be the tail risk to the upside, all the way back to where we were. Well earlier in the decade. And if that was to happen, number one, that would decimate the euro. That would accelerate the crisis on the other side of the ocean. It would also devastate the equities market, because everything is priced in U.S. dollars. So that would mathematically have to reduce the prices. And on top of that, there's with all the industries that are breaking down, you've got so many areas that is going to fuel a crisis that it's going to be hard to see straight unless you actually are able to see through what is happening and you take the other side of the trade or sit on the sidelines until the storm, and I would have to say the perfect storm, abates. And there is no signs of that perfect storm abating, at least in a significant way, until May of next year, maybe as early as February, but then we've got other things to worry about at that time. And, we also got high-grade debt breaking down now. We've got sovereign debt, breaking down based on the PCY index. So no matter where you look, it's extremely bleak if you're on the long side. Now, one thing to keep in mind and focus on is, beyond the VIX index, and I've indicated this many times, is the index called the S&P 500 Put Right Index. Now, when that index falls, it means that people are very, very nervous about actually being short puts, because that means that there's an unlimited risk. Well, I wouldn't say unlimited, but it just means that if you're short puts and the market could and the market starts selling off, markets could go down very, very low, and that could actually, be extremely dangerous for people that are short puts. And it is a much better indicator of volatility going forward in the future than the VIX index, because the VIX index is made up of both calls and puts. It's not, spread trading could actually interfere with it, but the S&P Put Right Index is really one of the best fear gauges that I've seen in market history. When there's a sell-off, you can see here in July, we had a sell signal here. It forewarned about the crisis. If you go back over here in 2008, we actually had a sell signal up over here, and it forewarned about the crisis. So right now, I'm going to take you to a daily chart, and you're going to see it's warning us about a major, major drop in the Put Right Index. And when I say major, I mean major. I'm talking about a move. And I'm going to zoom in a little bit more here. And I've been harping about this for weeks now. And you can see here there's been dramatic sell-offs continuing, okay? And, now, beginning to escalate. And I'm expecting it to come all the way down to the 680 level. So a 50% drop in this index, which means at least 100% increase in the volatility index. But you know what? What's even worse is that if the volatility index, the VIX, doesn't go up while this thing crashes, it actually makes the crash even worse, because it means people are still complacent while the market is falling apart, and that will continue to fuel the sell-off. Okay? So basically, I'm going to take you back just to the short-term chart that we were just looking at on the S&P, just to, excuse me, not this chart here, but taking you back to the 89-minute chart on the S&P market. And what you should be focusing on over here and is not to get excited by this rally that you may be seeing in the NASDAQ right now, and the rally off the lows, even though it's down right now, that you're seeing in the S&P, okay? Because it is capped in this area, and there are boundaries here that are projecting well below here, and on the longer term, dramatically lower. So buckle up, and and stay tuned for further updates at nakedswantrading.com. And you could subscribe to our free weekly webinars, updates that I'm providing right now. We really call them weekly updates, and also special live webinars that happen from time to time. As well as get updates regarding the special launch of our product that is going to be opening up some of the best opportunities that we see going forward in high-impact equities and ETFs around the world. So thank you so much for joining us today at nakedswantrading.com, and for following us on the Twitter handle at nakedswantrader on this 4th of June, 2012, and with this commentary ending at 2:33 p.m. Thank you.